Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9 where we break down the day's action on the Lal Street. And Indian markets, they ended little change once again on Wednesday, the weekly FNO expiry for the Nifty bank contract. Now the headliners, they opened with moderate cuts today, roiled by global headwinds. Nifty even broke below the 22,400 level in early trade, but by mid-morning that level was reclaimed and the market went on to test record high levels by about 1 p.m. or so. Spoiler alert, we did not get there. And since bulls, they looked exhausted around that 22,500 mark, bears took over and they were able to pull Nifty about 76 points from its intraday high. The index ultimately settled with a cut of about 0.08% at 22,434 mark. The 30 share Sensex on the other hand settled just about 27 points lower below its previous close at 73,876 mark. And while the action on a day-on-day basis was not noteworthy, the session itself gave us some sense of the overall sentiment of the market. One, the Indian markets are not really paying attention to the global headwinds. Over the course of the last few sessions, we have had a slew of stronger than expected macro data releases in the US. That, by the way, has sparked fears that rate cuts, they are going to be pushed back even further from June of this year to maybe July now. And this has led to a surge in the 10-year bond yields in the US, which, by the way, are now at a 4-month high at 4.35% or so. The dollar index has also, it's also holding around that its 5-month high. And as we know, a spike in these two is bad news for emerging markets like India. Adding to the pain is the surge in crude oil prices. Brent crude is now, above $89 a barrel, and it's approaching uncomfortable territory for us. Remember, we are net importers of oil, so a spike in oil prices will lead to inflation. Also, crude is a key raw material for multiple industries, paints, rubbers, chemicals, a few of them. So this surge will not only negatively impact their profit margins, so it's a double whammy of sorts for us. Second, we are still trading in a range, but the base that is shifting lower. Nifty in the last 3 sessions has been making lower lows. On an intraday basis, while we have struggled around that 22,500 mark, the base is shifting lower, and again 22,500 is where we have formed multiple tops. So this overall is sentimentally bearish as far as the headliners go. But when it comes to the broader markets, the recovery has been quite phenomenal over there. The mid-cap index today hit a fresh record high after a gap of 37 sessions. The index, by the way, is now on an 8-day winning run. The small cap index, on the other hand, has clawed back about 78.6% of its entire fall from record high levels to the March low. And the index again too is on a 8-day winning run. But that's enough from me. Joining us on the show now is a market veteran, Mr. Kranti Bhatini of WealthMills Securities. Sir, thank you for joining us here on Last Tick. And the markets have had a strong run lately, right? But the global, the global cues, they have emerged as a pain point. The bond yields in the US, they have picked up. Brent crude prices are inching closer to $90 a barrel. If the situation worsens from here on, what sort of an impact can these global headwinds, have on our markets?
Definitely, Suyash, you rightly mentioned the global headwinds can be the headwinds for the Indian economy also and for the Indian markets also. But currently, look at the inherent strength of the economy that's playing the more momentum role on Indian economy at this point of time. Look at the manufacturing PMI. PMI is at 57 points. That means the 50 points is fabulous and it is way above the 57 points. So it shows the exuberance in the economy and the inherent strength in the economy. And the global setup, even though slightly lingering, but the domestic factors like the liquidity flows into the Indian markets has been quite strong, and the sentiment is quite strong towards the Indian markets. That's where the market is heading towards a positive territory. Most probably we can see the markets to consolidate, but we don't expect a deep correction in Indian markets going ahead. If there is a deep correction, we are going to witness a shift recovery because of the strong liquidity flows that are getting back into the Indian markets.
But with China steering some sort of a recovery, and we have spoken about this at length, how India is twice as expensive as China, but now they are steering some bit of a turnaround, and it looks like we are at an inflection point as far as that buy India, sell China sort of a trading strategy, which had been a popular trading strategy, by the way, since COVID, Kranti. Do you see our inflows getting hurt because of what's going on in China, especially the kind of recovery that they are seeing?
Some portion of global allocation, Suyash, okay, they might be going towards the Chinese market. But coming back to India, there is a ample liquidity that is available for the Indian markets, and what are the flows that are coming towards the emerging markets. Greater pie is going to come to India. That's what we are going to see. Because the China, the one problem is, of course, the valuations looks attractive, but the policy obscurity, that's where the key problem for the Chinese economy and the Chinese companies. Whereas India coming to the economy, look at the policy continuity and also the transparency what we are gaining. That's where India have an edge going ahead right now. So we can expect the continued greater flows towards the Indian markets going ahead.
All right, and keeping it with China, I mean, for the last 10-15 years, China was giving deflationary pressures to the entire global economy. I mean, the per capita income over there, I mean, that has pretty much skyrocketed over the last few years. It has grown by about 70-80%. And I was reading some of the commentary from some of the Fed members, the voting members, and one of them is of the opinion that we need to relook at that 2% inflation target. 3% seems like the new normal. What's your opinion, in all of this, Kranti?
Suyash, see, in an emerging economy, and when the demographics of any economy is in favor of the growth, so the inflation tend to be on a higher note. Whereas coming back to India, look at the demography of Indian economy. And also the way we are progressing. We never in a bubble territory. The economy is growing in a very steady growth. We can't compare the Indian economy directly in proposition to China because of the reforms what they have taken. It's completely different, and they have been continuously growing for 10-15 years at about 10% growth rate. That's where the excesses have been built up in China. Whereas coming back to the Indian economy, we have been on a consistent path. We never had any kind of loose monetary policies, and also the currency stabilization. What we have done is in a different way. But the Chinese, the monetary policy as well as the currency policies have a different tango for their the processes and policies. They try to maintain depreciated currency, whereas they used to get the pressure from US to strengthen their currency. So these kind of tussles have been there for the other economies. Whereas coming back to India, we had a very stable policy regime. That's where India is getting the edge right now, and we never had a zero deflationary policies also. We never had a deflation in India. So our growth prospects are quite good, and we always RBI have a comfortable range of 4% of inflation. So that's where the Indian economy is getting an edge. One thing is, Suyaj, we talk about too much about inflation,
Right.
but the deflationary condition is much worse than an inflationary condition. So one need to maintain the good pricing power, and also we should not look at to the economy where the prices are skyrocketing like Turkey and other economies. So it is a very interesting theme. But
Right.
what I can say is, in India we are at a very comfortable range for the population, to the general public, and to the regulators also.
All right, and I mean, to your point, sir, certainly striking a balance between, you know, the two forces, deflation and inflation is the key, and I think that's what the central banks are struggling with. But coming back to our markets, I mean, the recovery in the broader markets, sir, that has been rather phenomenal since mid-March, you know, when the sentiment was pretty much at its weakest. And you know, if you look at the performance, I mean, mid-cap index has scaled a record high. Both indices are on a 8-day winning run, you know, but considering how flip-flop the commentary has been around this space, do you think this recovery is sustainable?
Sure. See, one thing we need to acknowledge is the regulatory measures that has taken by the regulators in the past 1 year. Normally, if you look at the market history, starting from 2005, 2008, 2011, whenever there is a bubble-like situation in the market, whenever there is a correction in the market, and whenever the FIs have been exiting from the market, because of the leverage positions that are built up in the markets, market used to get into a crash kind of situation. But right now, if you see, we had a strong commentary in the past fortnight. End of the financial year, markets have taken some kind of given a knee-jerk reaction, but what we witnessed is a swift reaction, both in terms of the indices and also the broader market. What I mean to say is, right now the leverage positions are manageable right now, and every stock have its measures to control the pace of growth of the stock. So what we can see is the kind of bubble-like situations are very limited right now because of the policy making measures are taken by the regulators at the stock specific level. So there might be cases, I am not denying the fact, but the broader strength of the market is quite strong. The setup is quite strong. The way, the pace, how we are going is quite strong. And also, Sriya, just to mention, right now, earlier, there were some traders, there were some investors where we interact. They used to tell, we used to do stock trading, giving any upfront money to the stockbroker. That means they used to take a lot of leverage and used to make money from the market because of the skills they have. Right now, today, any investor or a trader want to buy any position, they need to give upfront margins set by the exchanges. So they need to maintain the all the margin requirements. That's where the leverages get controlled, and it's not going beyond a limit. So right now the economy is flooded with a strong liquidity at this point of time. Strong liquidity is coming into the markets at this point of time, and the serious investing nature is going up in the market right now. Rather than taking the high-end leverage position, there will be some cases. But majority of the market, if you see, the leverage positions are very less. That's where the market is holding right now at this point of time. What we witnessed is a swift recovery in the markets.
All right, quite a few interesting points that you made over there, sir. But I think the broader theme is that, you know, the markets will continue to do well, mid caps and the small caps. It's a multi-year story. I mean, still the ride could be choppy on the way up. On that note, let's slip into a short break, but please stay with us as we have lots to talk about on the other side.
Luxury is now becoming a need rather than something that you aspire to be. So that is adding a lot of fuel. Obviously, government has played a vital role in it.
In a city like Mumbai, a luxury home may be something upwards of rupees 10 crores. In city like Delhi, again, maybe something upwards of 8-9 crores. But in Bangalore, we typically define a luxury home, anything which is upwards of about 3 crores.
It's a combination of increased wealth, availability of more luxurious homes, and simultaneously the overall economy doing better.
Welcome back. You're watching Last Check here on News9. And Kranti, we were talking about, how the broader markets, they have been able to stage this phenomenal recovery. Another sector that has made a strong comeback in the last couple of years, NBFC stocks. I mean, this particular space was under fair bit of pressure in the recent months amid RBI curbs on unsecured lendings and crackdown on companies like IAFL Finance. But with this sharp reversal that we are witnessing in the last couple of weeks, do you think the time is ripe to invest in these stocks, considering that monetary easing is just down the road? If so, what stocks do you prefer in this cohort, sir?
Yes, you rightly mentioned there is a buying interest is emerging with respect to the NBFC stocks are concerned. What it seems to be is with the long-term averages of NBFC stocks are concerned, they are nearer to their long-term averages at this point of time. As given the kind of the news of monetary easing that might come anytime soon, that's what the expectation is just a couple of days back. If that can come, definitely these NBFC stocks are going to take a advantage going ahead, because the credit growth, the momentum need to go up. So the credit lending also very important for the economy to be in a momentum zone. So at this point of time, I try to stick with the large cap stocks only. It's going to, there are more number of players in the NBFC space, and new entrants also coming like Pyramid Enterprises and the other companies like other companies also entering. So the one need to have a very stock specific action with this. I try to stick with the large cap space at this point of time, rather than venturing into the new entrants at this point of time.
All right. But moving on, the first IPO of FY25 has opened for subscription. Bharti Hexacom, which is a subsidiary of Bharti Airtel. Now, the IPO is a complete offer for sale, meaning all the proceeds will go to the selling shareholders, which in this case is just one, Telecommunications Consultants India, which is a government company. Now, personally, I typically don't prefer such issues, since no money is going to, the company to fuel further growth. But Kranti, the company does have a strong parentage. It also enjoys leadership in, in Rajasthan and Northeast circles. Also, the issue seems fairly priced, and the anchor book is rather strong with marquee names like Abu Dhabi Investment Authority, Fidelity Fund and Morgan Stanley. I mean, what's your take on Bharti Hexacom IPO worth subscribing?
Sure. Given the kind of pedigree the stock, the company enjoys, I'm not a person to go and buy in a hurry in a IPO. Okay, the business prospects we need to see. Looking at the company fundamentals and the business prospects are concerned, as you rightly mentioned, it's a OFS, and the company operates in a limited set of pockets like Rajasthan and predominantly Northeast, and also their focus is on broadband and also the fixed landline. So I'm not much excited because of the business model is concerned at this point of time. So I try to avoid subscribing for the IPO. But given the kind of the momentum that can get created with respect to the IPO market is concerned, if anyone is looking forward for any kind of listing gains, they need to see the anchor book position, and one can subscribe for a medium to short term, but not for the long term.
All right. And shifting focus to stocks, there are a couple I wanted to pick your brains on. Let's begin with Vodafone Idea. The shareholders of Vodafone Idea have approved fundraising of up to 20,000 crore through a combination of equity and equity linked instruments. And I mean, this is, by the way, less than half of the initial planned fundraise of 45,000 crore and less than about 10% of its debt obligation. So sure, the company needs to do more, but I mean, at least it is a step in the right direction, right? It will help, this fundraise will help it remain competitive in an industry that looked like was moving towards a duopoly. Kranti, your thoughts?
Definitely, Suyash. Okay, the one problem with Vodafone is, forget about the valuations for a while. Okay, the business fundamentals, the gain of new customer base has been, the subscriber base and the ARPU has been under pressure. So, as you rightly mentioned, under the duopoly, as Vodafone is right now, the current fundraising definitely is going to give a oxygen to the company in the medium to short term. So if the investors have a very high risk appetite, I can consider Vodafone is a complete dark horse for the investors or traders at this point of time who have a high risk appetite. One thing is clear, the company is going to sustain at this point of time. There was a worry that in India we have, in terms of the telecom companies is concerned, from 25 companies, we came down to 2.5. That is, people used to say Vodafone is half dead. That's what the narration was a few months back. But given the kind of fundraising plans the promoters are doing, okay, it gives definitely oxygen to Vodafone. So if the investors have only high risk appetite, one can get into stock names like Vodafone. Otherwise, if the investors don't have that kind of high risk appetite, it's not the place to be.
All right, only invest in Vodafone Idea if you have a high risk appetite. Maybe that stock, since we don't have clarity what the company is going to do next, how it will compete with the likes of Jio and Bharti Airtel as far as 5G rollout is concerned. There is, a lot to be answered as far as Vodafone Idea is concerned. So perhaps it's still a speculative trade. But moving on, sir, HDFC Bank, I wanted to talk to you about that also, has been on a bit of a roll lately. I mean, it's on a 5-day winning run, has rallied about 4% in that time frame. And on the price charts at least, there is a technical breakout. The stock was, by the way, stuck in a range since late January, but we have closed above it. Kranti sir, coming to you, do you think that it's just a technical breakout, or is there a fundamental trigger for this upswing?
Yeah, sure. This stock has not participated, but given the kind of recovery what we are witnessing in the indices, HDFC is one of the stocks that has been making the indices to stay in the positive territory. But we need to keenly wait and watch for the results for the HDFC bank is concerned going ahead. I'm sure that definitely there will be a good amount of recovery that would have taken place in terms of the earnings of the company is concerned. But still, most probably the bank may take another couple of quarters to get the expected delivery for the key parameters going ahead. So if I am a long-term investor, if anyone is a long-term investor, definitely HDFC Bank at these valuations is a compelling buy at this point of time, given the kind of market conditions at this point of time. So, yeah.
All right, and I mean exciting news for us investors out there, because this stock is pretty much in everyone's portfolio and the stock is finally moving up after this long period of slumber. Good to see HDFC perform, and even this large cohort of private banks, they are finally participating in that rally. But so shifting focus now.
Yes. On a lighter note, HDFC is a consensus buy for everyone. Whenever there is a consensus buy, the stock get into a consolidation. Okay, there was a consensus buy for LIC earlier, and how the stock tested the patience. When the consensus buy has gone, the stock has rallied. So that's the reason Ben Graham always says market can be irrational till the time you are rational. So sometimes market tend to behave in such a way.
I hope investors of Kotak Mahindra are listening to you, because that is another one stock that has been in this long period of slumber, has not done anything in the last couple of years. But since we are running out of time, one final question from me, sir. RBI's first policy decision is due to come out on April 5th, that is Friday. And at this point, I mean, we have discussed this at length before also. And I mean, no one is really expecting a rate cut. But, some are factoring in a shift in stance from withdrawal of accommodation to a more neutral stand. By the way, that should provide, a runaway for rate cuts down the road. But the big question really again is, when is that rate cut going to happen? What's your sense? Is August or October, by the time we have more clarity on the monsoon turnout, is that the time period when RBI will start cutting rates?
Yes, you answered the question also. As you rightly mentioned, RBI is going to keenly observing the monsoon and the first rate cut from Federal Reserve. So these are the parameters RBI has keenly watching. So with a strong good monsoon, and also oil getting stabilized below $80 per barrel. These are the key points where RBI is going to observe, the MPC is going to observe. If the early rate cut comes from Federal Reserve, that will prompt the RBI go for a rate cut in the subsidizing MPC policies meetings are going to consult. So right now, I expect a status quo at this point of time because RBI is not in a hurry to reduce the interest rates at this point of time, because we need to keep the Indian 10-year. One hand, we are developing the strong bond market in India. So at this point of time, the government RBI also looking to make India's 10-year bond yields also attractive for the global investors. So these are the parameters MPC is going to consider before taking any decision.
All right, and very interesting point that you made over there, sir. I mean, that differential between the 10-year here and the 10-year in the US, that is getting squeezed out. I remember before COVID, it used to be around 5 or 6%. Now it's just about 3% or so. So maybe RBI does wait for, Fed to give it some cues before going for monetary easing. But again, thank you for giving us time here on News9. Always great insights from you.
Thank you, Shiash. Always my pleasure.
All right, with that, it's a wrap on this edition of Last Take. We'll see you tomorrow at 9:45 a.m. on First Take.
You're watching Business Plus. Gold prices have surged to an all-time high yet again in April, driven by expectations of interest rates reduction in the US and the metal's status as a safe haven asset, and on account of the fresh escalations of geopolitical tensions in Central Asia. Gold prices today climbed